Hello everyone, we are Group U5 and my name is Garo Karapetyan and my team members' name are Arshak Torosyan and Kiefer Godinez. Our topic is analysis of accounting method differences in the auto industry. I will be doing the introduction and ending with lease classification. Kiefer will talk about property, plant, and equipment and end with income statement and OCI. Arshak will talk about recognition of sales of services and end with a conclusion. Ford Motor Company was incorporated in 1903 in Dearborn, Michigan. They have subsidiaries worldwide, such as in Ford South America, Ford Asia Pacific Africa, and Ford Europe. Ford operates in the automotive and financial services, and they follow US GAAP for financial reporting. Daimler AG, founded in 1998 in Stuttgart, Baden-Württemberg, Germany. They're a subsidiary of Daimler-Benz, and Daimler AG is the parent company of Daimler Group. They follow IFRS for financial reporting. Differences in the accounting methods. The convergence to IFRS from GAAP is taking place gradually. However, there are still several major differences in the accounting methods used. While both methods are highly developed, there are still several significant differences, such as inventory. US GAAP allows companies to use LIFO, FIFO, or weighted average as their inventory costing method. IFRS disallows the use of LIFO, leaving FIFO or weighted average method to be used. This creates differences in the calculation and comparability of cost of goods sold, which affects net income as well. Contracts. US allows companies to use percentage of completion or completed contract method for revenue recognition. IFRS, however, on the other hand, prohibits the use of completed contract method. This creates differences in the timing of revenue recognition and net income. Discounting of revenues. US GAAP requires discounting for certain industries or if revenue is deferred for more than 1 year. IFRS uses discounting more often. Anytime revenue is deferred, discounting must be used. Generally, this will make the IFRS revenue contain more discounting and reflect less amounts for revenue. Contingent considerations. US GAAP requires that the contingencies be resolved before revenue can be realized, even if the delivery of products or services has occurred. IFRS requirements are that 1. Significant risks and rewards of ownership have been transferred. 2. The entity does not have any continuing managerial involvement. 3. The amount of revenue can be reliably measured. 4. The probability that the economic benefit will flow to the entity. And lastly, 5. The cost associated with the transaction can be reliably measured. Impairment loss. Under US GAAP, the calculation for impairment loss requires a two-step impairment test and measurement. The first step is to compare the carrying amount with the undiscounted future cash flows. If the carrying amount is less than the undiscounted future cash flows, then there is no impairment and no loss is recognized. If the carrying amount is greater than the undiscounted future cash flows, the asset may be impaired, and the impairment loss to be recognized is the difference between the carrying amount and the fair value. US GAAP prohibits the reversal of asset impairments. Impairment loss under IFRS standards. Asset impairment is subject to a one-step impairment test. The carrying amount of the asset is compared to the recoverable amount. The recoverable amount is the higher of 1. The asset's fair value less cost to sell, or the asset's value in use. The amount by which the carrying amount of the asset exceeds its recoverable amount is the impairment loss. IFRS allows impairment loss to be reversed if circumstances change. Lease classification. US GAAP has 4 criteria for determining capital lease. First, first criteria is that the lessee gets the ownership of the property at the end of the lease term. The lessee has the option to purchase the asset at bargain purchase price, or the lease term is equal to 75% or more of the economic life of the leased asset. And lastly, the present value of the minimum lease payments is greater than or equal to 90% of the fair market value of the leased asset on the date of inception. Even though IFRS follows similar criteria for classification of a finance lease, there are no quantitative breakpoints or bright lines to apply. And now I will pass over to Kiefer, and he will continue with the presentation.
Thank you, Caro. Another difference between IFRS and GAAP is in property, plant, and equipment. Under US GAAP, property, plant, and equipment is not separately accounted for, while under IFRS, separate components of property, plant, and equipment with different economic lives are recognized and depreciated separately. Both methods, however, use the straight line method in order to account for property, plant, and equipment, and the IFRS method is more precise in terms of traceability. Advertising costs. Under GAAP, a company has the option of expensing their advertising costs as incurred or deferring their expense and recognizes it eventually. In this case, it would result in a lower net income, while under IFRS, the costs of advertising are expensed as incurred, which leads to a more accurate and lower net income as opposed to a company that chooses to defer their advertising costs. Asset retirement obligations. Under US GAAP, the AROs are recorded at market value and are obligations that relate to the acquisition, construction, or development of a long-lived asset. And to find these AROs, a credit-adjusted risk-free rate is required to discount the asset retirement obligation when using the present value method to estimate the fair value of the liability. While under IFRS, the asset retirement obligations value is determined by management's best estimate of the costs required for dismantling and removing the item or storing the site on which it is located. As for the presentation of the income statement and statement of comprehensive income under US GAAP, follows a two-step process. Under the single-step format, all expenses are classified by function and then subtracted from total income to come up with income before tax. The multiple-step format, on the other hand, separates operating and non-operating activities before arriving at income before tax. For the income statement and statement of comprehensive income under IFRS, they allow the company the choice of stating expenses either by their function or their nature. If they choose to report their expenses by their function, additional disclosure of expenses will need to be required. They do not recommend companies to mix functional and nature classifications of expenses. And now I'm going to pass it to Arshak. We'll talk about recognition of sales of services.
Thank you, Kiefer. Under US GAAP, sales of services are recognized when services are performed. And under IFRS, sales of services are recognized as percentage of sales. This is similar to the percentage of completion method that Garo discussed earlier. Extended warranties. US GAAP does not require fair value allocation to extended warranties if it is sold as a bundle package. On the other hand, IFRS specifically allocates the fair value of the extended warranty to the bundled package sale. This results in a revenue recognition timing difference. Disclosure similarities. Both US GAAP and IFRS require disclosures if the entity's financial documents are not presented with the entity as a going concern, when the money is presented in financial statements that are from discontinued operations, and when the companies are experiencing hyperinflation. Disclosure difference. If an entity receives proceeds from insurance, US GAAP requires disclosure of the nature of the event and the amount that was recoverable from the insurance proceeds, and IFRS requires disclosure of the proceeds and the amount included in net profit or loss. So it's a little bit different. Conclusion: IFRS and US GAAP differences create different end results for Ford Motor Company and Daimler AG. With the conversion of US GAAP and IFRS, accounting standards can be combined to create a universal standard for preparing annual reports to make it easier for investors to compare and analyze. Thank you for the presentation. Here are some of our bibliography sites. Thank you again.